Okay, we're going to start now by looking at the S&P 500 like we usually do. You can see that we've broken through a lot of support that we've had going back 1 year. We have a situation right now where we things are lining up in our list of meeting notes. Okay, we made a list of possible catalysts for the stock market to go down. And we have a bunch of these lining up right now. One of them being lack of confidence in the AI story. For the past month, we've had a lot of disruption in the tech world where there's a lot of disruption happening because of AI. So we have a lack of confidence in general in tech. We have tariffs as a side concern. We have another problem where AI could cause layoffs, and that could cause credit defaults. And we do have an issue right now with private credit, and there are some companies that are coming up fraudulent in private credit. It's a big thing because it's a lot of banks, a lot of big banks, and private lenders such as Apollo, a lot of other Blackstone, they are lending to companies that are turning out to be frauds. And they are saying now that this could be like a rhyme of the financial crisis. It's similar to it. So we have that as a concern. And how on top of that, we have a war with Iran. And that is that is causing the stock market right now to be in a mode of selling. Um, we have the major problem with the war in Iran right now is the major oil producers in the world are cutting production because they can't deliver their oil due to the closed Strait of Hormuz. So what that's doing is it's causing higher oil prices. And when there's higher oil prices, the global economy slows, not only in the US, but around the world. And that's going to cause the stock market to go down if it continues. So these are some pretty major issues in the stock market. And um, it's a perfect mix right now for the stock market to have a big correction. Now, let's go back to the S&P 500. You can see right now, as of Friday, this Friday, the S&P 500 held at the 150-day moving average. We've been holding at the 100-day moving average going back a year, and we're losing support now. It looks like we're going to open on Monday at the 200-day moving average. That is a super major level of support for the stock market. And if we break through that, then we just go down in integers on every stock until it crashes. So we will hope that on Monday morning, the um, the level of the 200-day moving average will hold. We are oversold right now. Um, let's look at the oversold indicator. We are at -4 in the S&P short range over oscillator. And when it's at -4, let's look at our chart. S&P short range oscillator is below -5 or approaching -10, indicates the market is heavily oversold, suggesting a potential rebound. Okay, so last time we had this kind of situation was the tariff conundrum of last year at this time. And let's look at that, what happened there. You can see we had a huge rush downward, very similar to what is happening now. But there was a resolution, and It was the Trump undoing what he did, and the stock market went up. Now, oil prices are at $110 a barrel now, which is pretty high. And one announcement from the president, such as "We're done bombing, we're going home," will make everything flop and the stock market go up, just like last year. Is that going to happen? Well, I'm starting to take President Trump's word whenever he says it's going to be a multi-week affair. So I don't expect a big bounce back like this. I don't expect an announcement of termination of the what's going on in Iraq anytime soon. So don't count on that. Um, the important thing is if you're investing for a long term, you have to think about um, is this situation going to affect the long-term prospects of the company that I'm following? So let's look at, okay, let's look at some more of our numbers. What's interesting about this week is we had the 10-year yield go up. If you look at the 10-year yield, you can see that it went down a lot until last week, whenever we started the war. And as soon as the war started happening, we started increasing the yield on the 10-year in a major way. So that is really what's happening right now is with the oil shock and the oil going to $110 a barrel, that means inflation is going to go up. And when inflation goes up, um, that is an indication that the Fed is not going to reduce interest rates, and or it might raise the interest rates. So that's why the yield went up. So we have some, what happened in the last week is very negative for the stock market. We have uncertainty. How much is the United States going to get into this? How long is the world not going to have a supply of oil? How long is the oil prices going to stay elevated? All this is causing havoc in the stock market. Okay, let's look at our stochastics charts. Hold on. Let's look at our stochastics charts for the S&P 500. I'm going to zoom in on this week just so you can see what we're doing here. Okay, you can see that we have followed this green 150-day moving average forever, and we just broke through it. So what that tells us is if you're a momentum trader and you've been riding a lot of stocks hoping this continues, we just saw our first break in in our channel in over a year. That's an indication that almost every stock in the stock market is starting a downtrend. Let's hope that it stops right here at the 200-day moving average, which is where it's supposed to open on Monday morning. And if it can go back to this range and go back into this channel, we're okay. Otherwise, we're in a major bear market. So we're going to keep an eye on this 200-day moving average. And the reason why we're going over these charts like this is is how to time your new purchases. Right now, um, right now we are oversold. So if you're not invested in the stock market, it's a good time to start looking for things to buy. Whenever Jim Cramer approaches a situation like this, he says that Mark Haynes told him whenever there's 10 to 1, 10 down stocks to one up stock, that is an indication you got to start looking for something to buy. And we're in that situation right now. But if you're already invested, now's a little bit too late to start selling. All right. So let's go back. to our meeting notes. Okay, so the big story of this week is, of course, the price of oil is up 23% in the last week. The Strait of Hormuz is closed. A lot of the major oil producers are shutting their production down, and that is a supply-demand issue. Whenever oil prices, whenever the supply goes down, demand goes up and the price goes up. So high oil is inflationary. We've been saying that forever. The low the low price of oil means a slow well, right now the high price of oil, higher oil price means that the it's going to cost more for the world to grow. And there's going to be less economic activity around the world. That could cause recessions if it continues. We don't know how long this is going to last. The dollar has actually gone up 1%, and the gold is down. So this follows our pattern as as the dollar goes up. Let's look at this pattern. A stronger US dollar tends to drive gold prices lower. So there's a one-to-one correlation this week. The US dollar index going up, the price of gold going down. However, in economic uncertainty like we're having right now, we expect the price of gold and commodities like silver to go up because it's a safe haven asset. Okay, so you can see that we're still in a downtrend with the dollar, but this activity in Iraq has made the US dollar go up. Let's look at the fear green index. We are very close to extreme fear right now. And the translation is start looking for something to buy. Warren Buffett said, be fearful when others are greedy and greedy when others are fearful. Right now, Warren Buffett has a ton of cash. He's been uh, accumulating oil stocks and um, he has not bought things in the past year and a half. So right now is the time Warren Buffett is, not Warren Buffett, but followers of Warren Buffett at Berkshire Hathaway are starting to look for things to buy. Okay, so we have bearish tendencies on the AAII survey, and the bearish tendencies, it's time to look for something to buy or don't sell. All right, the VIX is starting to go up a lot. It is in panic mode right now. So the VIX is over 30 right now. So that means this, people are afraid of the stock market going down, and we are in a panic crash fear environment at 30. All right, so here's our emotional graph. We're almost going to be at capitulation. We are very close to a point where everything goes down regardless of what it's worth. And we've been through these kind of situations before. I thought it'd be interesting. We'll go over a little bit later on, but we've been through a lot of crisis that seemed like the end of the world in the past. And if you look at the big picture, it's just a blip on the screen. Um, okay, so here's some issues that may lead to a crash. We've already said the AI stock bubble is in a process of bursting now. One of the biggest problems right now in this environment is the word debt. We have companies like the hyperscalers, like Google and Oracle, Microsoft, they're spending a lot of money and Meta on AI and with not a guarantee of return yet. And that is causing issues with people worrying about their debt loads or how much they're spending on these projects. And we do have that issue with private credit, which is a debt issue. Um, we also have the government, which is spending a lot of money on this war. And so debt is a major problem right now, and that has been one of the biggest issues in past crashes in the stock market. Okay, let's look. This is a very important slide right here. Let's try to get to this. Hold on. Okay, I'm going to get find another way to look at that. Okay, so so this is pretty important. The okay, this chart basically says what the stock market is willing to pay at certain yields. Right now, the yield is about 4%, and people are willing to pay in the past around 13 PE for that at that time. Right now, we're hitting all-time highs in the PE of the S&P 500. Um, and the last time the yields were at 4.3%, which is basically where it's at right now, the 10-year yield. Um, the stock market was willing to pay 16 PE for the stock market. That's around 20% less than it's at now. So if we return to the mean in the stock market to the average PE that is paid whenever you have this yield, then we have to go down 20% from where we're at right now. So in other words, for every stock that we're following, we have to keep track of the PEG ratio because the PEG ratio is basically, it tells us what the true value of a stock is. And in a bad stock market, in a bad market, in a bad tape, almost every stock they go down to, their PE rate, PEG ratio of 1. And you have to watch that. And that's a good time to start buying a stock. Let's look at, let me see. All right. Let's look at our worst to first. At the beginning of the year, we marked how well the worst and the best stocks did last year. The worst stocks last year were consumer staples, energy, consumer discretionary materials, healthcare. Those have turned into the best stocks this year, actually. As you can see, consumer staples is up 10%, energy is up 26%, materials up 9%, whereas communication services, IT, and consumer discretionary are all down in financials. So when we look at, it's interesting, hold on. When we look at our screen for this week, we can see a ton of banks in our screen as potential stocks to look at. You can see Wells Fargo, Citigroup, a lot of financial companies are in this list of stocks that could be good stocks to buy now. And that's probably because of this private credit issue, the problem with AI possibly having massive layoff implications. People might not be able to pay their credit card bills. So we have a lot of American Express in our screen. So that's just an indication that there could be trouble brewing in that part of the world. It was Wells Fargo. Okay, so a lot of banks in there. Let's look at, okay, this is the S&P sector PE valuations relative to history. You can see IT and industrials are some of the highest rated the priciest sectors and consumer staples. The least pricey are financials. Right now, the financials are screening really well, but they just have a bad news tape. They have a lot of worries right now that that are coming up every day. We had some fraudulent activity in private credit. We had possible defaults because of layoffs. So we have healthcare. So what does that leave us? We have energy, utilities, healthcare are kind of safe sectors to go through to go invest in right now. Let's look at some of those sectors now. I got some stocks to look at in that are safe. Let's look at some of the market movers before we do that. Okay, so we know the 10-year has been going up. So our cheat sheet is yields of the 10-year going up, positive for banks, insurance companies, brokers, firms, companies that don't need to borrow money, such as large tech stocks. It's negative for companies that need to borrow money, such as small cap stocks, high yielding stocks, home builders, and speculative non-profitable companies like biotech companies. So we expect to see in our list here any company that yields high and needs to borrow money should be doing bad. And we know price of oil, I mean, is going up. So anything that's related to oil should be going up. Let's see if that happens. A lot of these companies here are all safe stocks. You have companies that are food companies. Um, you have, let me see, Kraft Heinz, Kroger, food companies. You have some Campbell's food company. Okay, and we have a couple AI companies that are bouncing. They were down a lot. Now they're bouncing, such as Palantir, ServiceNow, Broadridge. Look at the ones going down the most. Okay, we have, these are all the AI related stocks. Um, Stocks that are big on the data center, such as Corning, they make the fiber for the data centers. We have SanDisk and Micron, they do the memory. So in a bad tape, when the stock market is crashing and going down, the good stocks go down with the bad. That's why we got to keep track of the PEG ratio and how much you're paying for a stock. Um, let's look at the sectors going up and down the most. Okay, we see consumer staples. Okay, XLP. We have oil and energy. We knew that would happen in energy. Okay, utilities. They pay a dividend and they're safe. Gold. Um, it's a safe haven in times of um, um, calamity. We have biotech and healthcare. Healthcare pays a dividend and it's a safe sector. All right. Ones doing the worst are home builders. If the interest rates are going up in a major way, that's going to totally affect the demand for housing. Same with the regional. You see, we have regional banking. They could be going down a lot because they lend a lot to companies that rely on borrowing money for commercial real estate. So let's look at the telecom ETF is going down because anything high yielding, if the 10-year yield is going up, then anything that yields a lot will be in less demand. Okay, that makes sense. Let's look at the rest of our talking points here. Okay, Dan Niles, oh, he picked a real loser with this PI. Its Impinj is down 45% this year. In a stock market, we looked at their fundamentals the first time he gave that recommendation, and they were like sketchy to begin with. In a bad tape, like we're experiencing now, companies that don't have earnings and really good return on investment, they're going to just going to crash and they don't have a floor really. So it's going to be very dangerous holding this one through a market correction. Um, Nike's down 10%, 11%, and we have Boeing. It's up 3% so far this year, and Cisco is up 3%. So we'll keep track of these picks. Um, okay, we last week we came up with this with the help of Google AI, what the current market narrative was and our game plan for surviving this market correction. Okay, so the problem is inflation and rates. It's higher than expected inflation now, especially with the price of oil doubling. AI is cooling off, and we're having a sector rotation from high-flying technology to defensive stocks. We're going to go over a couple of defensive stocks later on today. And okay, technical resistance, the NASDAQ 100, it's starting to breach some of the technical levels. So that suggests possible further downward testing. So in other words, what that means is we're testing these levels of support. So we're testing this 100-day moving average. On Friday, we tested the 150 moving average. On Monday, we're going to test this 200-day moving average. And if this fails, then what you have to do is you have to look back at every time we had support. Look at that right there. See that? That's exactly where we're at now. This right here is probably the next place we're going to bounce to. This level right here. It's at 653. And so you can hit that was a level of support right here too. But if that fails, then we have to see these other places that held like right here and here and here and here. And if it ever gets down to here, then it'll probably hold because that's like a multi-year level of support. You have to go back like multiple years and see, oh, that held right here also, and we have some support right there. So that's how it's going to work if we end up going down in a major way. Let's hope it doesn't get that far. Um, all right. So let's go back to what we were talking about here. So the game plan is to rotate into conservative stocks from high-tech stocks. Don't count on any, we can't count on any resumption of this upward trajectory. We broke our support, and anything that's momentum in your portfolio, you're counting on continuing to go up. Don't count on it now. Um, Look for companies with high free cash flow and low debt. So debt is a major issue right now, and that's why every week when I review information for stocks, we look at the debt level because that is going to help tell us if a company is going to be growing faster or not. Buy small amounts of quality companies as they sell off. So we're going to keep track of the PEG ratio, the actual fair value of the stocks we're following. And um, if the stock market crashes, the stocks will be selling under sometimes their true value, and we'll keep track of that. Um, look look for stocks selling at a low PEG ratio, and it's safe from disruption. That's pretty tough in this environment. Rotate to undervalued sectors relative to history. So we have this chart here of undervalued stocks relative to history. We just went over. We've got to make sure that we look for stocks that are on the bottom part of that chart. Okay. Okay. So that's we already talked about this last week. Let's review it. With the war in Iraq, the price of oil going up is inflationary. Consumers will have less to spend on goods, and they are increasing in price. Uncertainty with the oil supply, with the Strait of Hormuz closed, is going to slow the global economy. Um, Demand for U.S. goods and services are going to go down, so the companies in America that sell overseas are not going to sell as much. We don't know how that's going to affect the growth rate of stocks. It just depends on how long this lasts, this situation we're in now. The ramifications of being in a war, um, we don't know if America is going to be shunned. Are people going to still use Facebook and Google and buy our iPhones? I don't know. Um, we still have to determine, how that affects the stocks we're following. Okay, so in times of this kind of uncertainty, investors switch from risk on to risk off. So every day in the stock market, we're going to see a switch from risk on to risk off. So when we looked at the market movers, it's a perfect example of risk on. This is risk off right here. We have Boeing, safe and safe. Kroger, they sell groceries, safe. Um, Kraft Heinz, safe. Campbell, safe. RTX is they make defense contractor. That's good in this environment. Safe. Top decliners, risk on. So every day we're going to find that risk off is going down. No, risk off is going up and risk on is going down as long as this uncertainty exists in the world. Right. So I thought it'd be interesting to review some charts that are doing okay, um, that we're following. This is the defense ETF. Let's make it a little bigger. You can see that it's in an uptrend and it's a little bit overbought right now. Just think of all the bombs that need to be reordered from the major defense contractors, um, and all the work that they have to do fulfilling those orders. That's going to be a constant demand even after this war is over. The interesting thing um, about oil and defense, you also have to think about the contrary too. Right now, it seems like the obvious trade to buy oil, buy defense contractors. But if there's a resolution to the war, then all the defense stocks will correct, and so will the oil go down a lot too. So it's a very news dependent situation. Let's look at the next. Okay, the next stock is gold. You can see that the price of gold goes up whenever the US dollar goes down, and whenever the US dollar index goes up, the price of gold usually goes down in a one-to-one correlation, but it's a safe haven. It has done well since this time last year, and it is it is a safe trade for a crazy environment like we're in right now. So let's look at another chart. The financial, you can see that have been in an uptrend since February of last year. And we basically broke through that long-term trend line and we're in a downtrend right now. So this is exactly what happened to the S&P 500 this week. We went through the trend line, and right now we don't have we broke through the 200-day moving average. So right now the financials are looking like they're going to start going down in a downtrend. And it isn't until we see like a break out of that downtrend, maybe going up to here, that we might be out of that. Okay, so let's look at another chart. This is the energy sector, XLE. You can see it's in an uptrend, up 30% this year, and which is pretty amazing. It's overbought. It's going to continue being overbought. Um, we just have to watch that. if you're in this sector, you have to realize that any news story could totally affect the price of the XLE. And but right now, as long as the war is going, as long as large countries are stopping their oil production, the price of oil is going to continue to go up, and profitability of these companies are going to go up a lot also. Okay, waste management. This is a stock we'll go over a little bit later. Um, the great thing about waste management is they're not affected um, a whole lot by what's going on geopolitically or inflation or any of the other things that the stock market is worried about. So you can see it's making an all-time high right now. We're going to go over the fundamentals of waste management right now as a safe, um, safe stock for this kind of crazy environment. Okay, so let's see. Okay, so let's look at waste management. I did their earnings estimates for the next couple of years. You can see that they're growing 9% from last year to this year, and 14% from this year to next year, and around that 10% after that. So let's say they're growing, their PE ratio right now is 30. Um, a lot of times when you have stocks with moats, they can charge more than companies without monopolies. This company has a duopoly with Republic Services. So there's two big trash companies in America. And in good times and bad, people make a consistently more amount of trash every year, especially with household formations growing. So, so this company is excelling in this environment. You can see the PE ratio is 30. They're growing at 14, and they have a 3.3% dividend. So the total return is 14 plus 3.3, that's 17. And their PE ratio is, forward PE is 30. So their PEG ratio is about 2. So it's about 2 times overvalued, but it's always selling for a very high, rich multiple because you pay more for a car that starts in the morning, basically. Um, and you can see that Yahoo Finance's PEG ratio is very similar to what we come up with, which is good. Um, you can see that their profit margins are at the low end, but they're still acceptable at 10 or 11. The return on equity is 29, which is almost double what we're looking for. And they have more, they have, oh, here's one issue. They have 30 billion in debt and um, out of a market cap of 99 billion. So they do have 1/3 of their market cap in debt, which is a small issue. They are on a path of acquiring a lot of companies. They really recently acquired Stericycle, which is a trash for medical waste. So that's going to allow them to grow. They have multiple ways to grow their company. They um, they recycle. So they have the option of recycling. They're applying AI and automation to um, their recycling, and they have methane capturing technology for their landfill so that they can have um, energy production. So they have a lot of different avenues to make and to grow this company. I've held this since the pandemic, and it's been a good stock for me. So I've been holding it, and it's an example of a stock I don't even look at it the price every day because I know it's going to grow consistently around 14% um, a year. So let's look at another one. Kimberly Clark. This is a stock. It's a very conservative company. They make staples. They bought the company that makes Tylenol, and so they have some pharmaceutical. They sell toilet paper and tissues. So they are more of a staple. And staples are up 14% this year. So it's a very safe company. There's a steady demand in good times and bad. They're mostly American, so they're not going to be affected by geopolitical issues. Um, their their 4P is 13, so that's a really low PE. That's almost half of the market right now. And they went down a lot recently because they're taking over the company that makes Tylenol. And so they're only growing at 3%, and they have a 5% dividend. So this will be an example of a stock to buy for the dividend part of your portfolio. Um, so their PEG ratio is 1.75. Again, you pay a little bit more for a quality company that's consistent growth. The profit margin is decent. That's right at what we're looking for. Return on equity is like 10 times what we're looking for at 126, which is very good. Um, they have 7.5 billion in debt, which is around one-fifth of their market cap. It's not that bad. So I would want to see them pay that back on a regular basis to get to a lower debt level. So that's one thing to worry about, but it's not the whole, not that much. Okay, so let's look at another one here. Procter and Gamble. Procter and Gamble is a company that makes a lot of the staples you have at home, such as Snuggles and Tide and NyQuil. So they have some pharmaceuticals. They have Nuc- Neutrogena, a lot of stocks that you understand and use every day. They they're example of a stock that's been out of favor for multiple years, and this year they're taking off. They're only growing it. They're only growing at 6% right now. So they're growing at 6% with a 4.23% dividend. That's a 10.23% total return. Their PE is 20, so their PEG ratio is 2. Again, this company is um, they they're regular at paying dividends. This is more of a dividend part of your portfolio if you're interested in it. Their profit margin is really good at 19, and we like to have like 13 or so. And return on equity is 3 times what we're looking for. So that's really good. The story with Procter and Gamble, they're trying to reduce their portfolio of products and invest more in their highest conviction products. For instance, Tide is one of their best sellers. So they would invest more into advertising for Tide and get rid of a Maybelline product line where they didn't make as much money on it. So that's an example of what the story is for this company. But for me, it's a buy and hold and collect the dividend part of my portfolio. Okay, this I mentioned before the stock screen that we did has a lot of companies that are financials right now. Financials are seriously being looked at as under duress. Some of the bigger companies like JP Morgan, they know how to handle a financial crisis. They're not going to make the mistakes of lending, um, getting into really bad lending problems. JP Morgan said that there are some private credit issues, and where there is one cockroach, there's probably other ones. So if he said that, then there are probably going to be some financial companies that are going to get hurt with that issue. That's why you have a lot of those in the top 10 here. Um, let's look at some of this private credit financial crisis issue. Um, we've had a couple companies. It's called slow brewing scandal right now because there are companies like once a week or once every 2 weeks, we have another scandal where there's a fraudulent company that was borrowing money and they went out of business, and um, that's making the whole sector kind of sell off right now. So that's why financials are down this year. Um, it's an example of You have to be very careful around that sector now. Even though some stocks scream well, you got to keep a flag in your mind that this could be a financial crisis. Um, okay, we'll go over this one more time. We haven't gone over it for a while. It's important to realize right now that AI is disrupting companies. We don't know the extent to what's going to happen. There are predictions that there are going to be massive layoffs, and there's going to be um, a lot of companies that will be disrupted or might go out of business because AI takes over what they used to do with their products. Software sector, wealth management, that could be another reason why these financial companies are going down, like Morgan Stanley. We have commercial real estate pressure, um, increased corporate AI fear on earnings calls. Okay, so let's keep that in mind. This is another thing that leads the stock market to lose conviction. All right, so that's all I had to say for today. Hope you. Oh, I forgot one more thing. The I was mentioning earlier today about how some of the biggest events that seemed really big at the time are just a blip on the radar. So let's look at COVID. You can see how, it went down and then it went back up. It's just a blip on the screen. Almost every major event in the stock market, Black Monday, look at that blip. And then we see the stock market continuing. Tech bubble of the year 2000. We had Russia invades Ukraine. It seems so bad at the time, but the stock market is very resilient. And a lot of times, that one correction we have, the stock market within a year has already recovered from that. So, also, there was some research of how stocks do after those major events. And a lot of times, let's look at let's look at this. Okay, you can see that Lehman collapses. We have negative 34% a year later. But a lot of times, a year later, more than half of the time, the stock market's up after a major event. So you can't assume that the stock market is going to go down whenever something inconceivable happens, like Pearl Harbor. Let's look at research that was done about the oil spikes spook short term but reward long term. So S&P 500 average performance after crude rises 5% 2 days in a row. That's what happened this past week. And one month, the stock market's up 1% on average. 3 months, it's up 4.3 on average. 6 months, up 8%. In 12 months, the average return is 22%. So the moral of the story is um, you can't assume that whatever's happening in the world right now is going to stay consistent. We could have a announcement tomorrow that could just change everything. We don't know. But if you buy and hold, chances are that whatever we're experiencing right now could be a temporary blip in a long-term trend upwards. So I hope you enjoyed that talk. That's all I had to say for today. Um, oh no, I didn't. I got one more thing to say. This is example of a ETF that is doing really good right now. It's a Wisdom Tree High Dividend Fund. DHS is the symbol for the ETF. I thought it'd be interesting to look at the top holdings of this fund. You can see ExxonMobil, Altria, AbbVie, Philip Morris, Merck, Chevron, PepsiCo, AT&T, all high dividend paying stocks. All of these are local. They're USA based. They all pay a dividend of around 3 or 4%. And this is like the perfect, I was looking at this, the holdings, this is like the perfect ETF to hold in an environment like this. They pay a dividend. You have sectors that are benefiting from the war. We have, I guess, if the interest rates for the 10-year continue to go up, this will kind of be flat. But um, I thought it'd be interesting to look at that. So that's the last thing I had to say for sure. I promise this time I'm gonna go. All right. Well, have a great investing week, and I'll see you next week.